Welcome back to F.A.C.E, Jamie.
Great to be here. Can you see me okay or hear me?
I can hear you. Do you want to use your camera?
Yes, why not?
Okay.
Apologies in advance to your... There we go.
Perfect. Okay. So Jamie, really a fascinating time. We're seeing market history being made, especially with what happened at the BOE. It kind of gave people an inkling of what a sovereign debt crisis might look like. Is that correct?
Yes and no. I mean, certainly, I think yes, when you use the word crisis. Is it a sovereign debt crisis? I'm not quite so sure. I mean, when we talk about sovereign debt crises, we think of the Eurozone 2011, 2012, emerging markets. Those are sovereign debt crises. This, I think, is more, there was malfunctioning in the UK bond market and the gilt market, so the Bank of England felt it had to step in. I think, as we all know now, as we're seeing the reporting unfold and the explanations come in, it was to do with the pension funds in the UK. Their leveraged positions, their derivatives holdings, basically for their funding, pension funding, was exposed to sharp rises in interest rates. Ultimately, that's the crux of it. Of course, interest rates shot up, yields shot up a couple of weeks ago with the government's badly received fiscal plans, and these pension funds were hit hard, and the bank had to step in. So it was more of a financial stability issue, I would say. Of course, that played out in dramatic fashion in the bond market. We saw a record rise in 30-year bond yields, 100 basis points in a day or two, and then when the bank came in, lo and behold, about 100 basis points fall in the next day or two. So, huge swings in the UK bond market. I think we're entering a period of calm, relative stability now, but how long that lasts is open to question. And the big fear, of course, for global analysts and investors and traders is that there are similar problems in other pension funds markets, whether it be in the Eurozone and Europe, thinking the big Dutch funds, or even in the US. And
Yes,
we just don't know what's under the hood just yet. We just don't know what's under the hood.
Yeah, why don't we just touch upon why there would be a pension crisis? Could it be all the years of central planning that people that were managing pensions needed about 7-8% returns to keep it solvent and growing?
Yeah, I mean, I'll put my hands up and lay my cards on the table. I'm not a pensions expert, but I think from what I can see, I think not just in the pension funds world, but in the investment community, the broader investment community at large, the last 20, 30 years, we've obviously seen, we've seen interest rates and bond yields come down hugely. And certainly since 2008, they've been anchored, interest rates anchored mostly at zero. So to try and juice returns and to generate returns for investors or pension holders, pension funds have had to do a bit of financial jiggery-pokery when it comes to the derivatives markets, and to try and generate those returns. Their derivatives exposure has been, as we're finding out now, exposed to quick changes in interest rates. If you've positioned yourself for a low interest rate environment for years and decades, then any quick change in that is going to, it's when the tide comes out, we find out who's not wearing any shorts. And I think the reversal was so rapid, so sudden, that we saw that there were huge issues with funding. And so it's just basically another example of having to adjust and readjust to a non-zero bound, low interest rate, low yield environment. And 2022 has seen a pretty dramatic turn in that. And that's not going to come without any casualties.
Yeah, I mean, 40% decline in TLT is a proxy for 20-year, you're talking about treasuries here. So what's happening in corporate bond markets, and I'm sure they own some junk too. people are taking 30–40% unrealized losses at this point, right, on their bond portfolio. So the coupon
Yeah.
doesn't mean anything, does it, when you're taking those kind of losses?
No, I mean, you want to get paid back, of course, but if you're taking those losses, then that's a hard one to swallow. I think the corporate bond market so far has held up reasonably well, but I think that might be starting to turn as well. So we're in sort of kind of uncharted waters now. And I suppose the question from a stability point of view, as the Bank of England has highlighted, is, at what point, or do we get to those points where financial stability concerns are such that central banks and authorities are going to have to come in and, put a floor under this or stop the rot, or, there are certain aspects or certain points in these markets that needs to be fixed and shored up. And I think we might be entering that kind of phase now, with interest rates so relatively high. I mean, 4% interest rates, 2, 3, 4% rates is not high historically speaking, but compared to the last 10, 15 years, when we've all become accustomed to basically the zero lower bound, is quite a change in mindset for investors. And you don't need me to tell you how this year has panned out. It's a huge adjustment process.
So when we look at really the wrecking ball, why don't we get to the dollar? Because you wrote a piece about it. I was going to show it. I'm looking for it, but excellent piece you wrote on it, Jamie. Let me just find it.
Yeah, the wrecking ball. It's a kind of hackneyed phrase, but I think it's true. I think it's certainly playing out. The strong dollar is just a wrecking ball for the rest of the world, and it brings to mind that infamous quote, that famous quote from former Treasury Secretary John Connolly, basically, our currency, your problem. And that's certainly been a truism for 2022. It tightens the strong dollar, tightens financial conditions, emerging markets and overseas borrowers who are exposed to dollar borrowings and US borrowing costs. They are, again, it's just another example of having been used to what we thought was one stable world of investment and this sort of global structure of finance, of low interest rates and zero lower bound and low bond yields, and a relatively, sort of softish dollar. That's completely turned on its head, and the dollar rising is just causing huge problems in world markets for, pretty much everyone except the US, but of course the US is not immune. And I think that may be the next shoe to drop is the US economy. And
we have heard
markets.
Multinationals push back and use the strong dollar is hurting the bottom line of earnings.
Well, we get earnings season starting, and I think it's next week is when it really kicks in.
We've already heard it from companies, though, complaining about the strong dollar. That just started happening the last couple of months. They didn't hear about it, but now they're saying what a headwind it is. So is that the main problem, or are we also having problems exporting? Because I don't know what we export, maybe agricultural commodities, but are we having trouble being an exporter?
It's not showing up it's not showing up in the data yet, but of course, trade data is notoriously, it comes with a lag, and the effects and the impact of exchange rate moves again take months sometimes to filter through for companies to change their business plans. I think we may start to see that in the months ahead. We may see that come through into the hard data. But as you say, companies are certainly talking about it now. They're complaining about it now, which just gives you an indication of what's to come in the coming months. And it may not be too much of a stretch, although it's maybe on the margins just now. But if we're seeing all these central banks around the world, just spoken about the Bank of England having to intervene in its bond market, but in terms of foreign exchange, the Japanese have intervened.
Right, they started it.
They've started it. Now, the Japanese are notorious interveners, if you like, but for the past 20-25 years, it's been always on the other side, it's been dollar buying, isn't it?
Yes.
This one is, again, turned on its head. They've been buying yen for the first time since 1998, and other central banks in Asia are buying their own currency to try and lift them up from historic all-time lows against the dollar. Even the Swiss National Bank, can you believe it, is intervening again in small amounts, but it's symbolic. They're intervening to buy the franc, having spent about 350 billion francs in the last 6 or 7 years on the other side. So it's quite a major shift, and I would not be surprised if the dollar rally was to continue, that we do start to get some sort of some noises from G7.
Okay, so
not at the behest of the US,
yeah,
but
more
from
than noises.
other central banks. Yeah, more than noises. Other central banks, other countries are going to be putting pressure on Washington to at least recognize that this can't continue.
Don't you think they're doing it already? You think we need a retest of the pound going under 104 for them to want to do something? Do they have to be? Because that's what that's what I would think. Why use any ammunition as long as the market's doing their job and we're respecting the levels? Like what was it, 146 yen? That's where they came in.
Yeah.
And where the BOE came in at what, 104,
103. Yeah. Well, don't
103.
forget the BOE didn't come in to intervene on the pound. It came in to intervene in the bond market. Of course, that had a direct impact on the pound, and we're back up at, I think, what, 110, 112 now.
Yeah.
So again, a period of relative calm and quiet on the FX markets. But were sterling to head back towards parity or back to those lows, again, the UK has got a current account deficit of around 8% of GDP. It relies heavily, to quote Mark Carney, on the kindness of strangers. UK assets, if they were to go down another 10% in price again, and we get ructions in the bond market and parity with sterling dollar is back in view, it's unthinkable that the bank wouldn't be having those chats behind the scenes with Washington and at a G7 level.
Don't you think it's going to take more than a communique? It's going to actually take the action. Do you think they could jawbone this for a while?
I think that would be the first port of call. Do you not think? I think they would start by firing a shot across the bows. They would maybe come out with a communique, a statement, and portraying a united front. From what I can see, G7 over the last 25 years or so, if the G7 comes out and says something on currencies, presents a united front, I think the G7 tends to get what G7 wants. Now, would that positive result come from just the result of a communique or a statement? Perhaps not. They might have to actually intervene in the market. But if you take the maxim, don't fight the Fed, then why would you want to fight the G7, the Fed plus 6 others?
Yeah. So here you talk about people that are skeptical about it having impact and having lasting impact. You give some examples of, why don't you talk about prior examples of when central planners were effective in the currency markets intervening?
Well, they intervened. I mean, the history of G7, well, certainly say, for example, since the launch of the euro, we all recall that a year, 18 months after the euro was launched, it was tanking. It was launched at 117. It got down to around 82 cents.
Yeah.
What happened? The central banks came in, and I think the euro virtually doubled over the next, 15 years or so. We got up to, what was the high in the euro? I can't recall, but 160-ish.
Yeah.
Now, was that all down to G7? No, of course not. But again, and then you go back further to 1985, in Plaza, when we had the Plaza Accord, dollar was much higher than it is now. The Plaza, I think the dollar had already started to turn. We had the Plaza Agreement, and the dollar virtually lost about 50% of its value in the next 18 months. So much so that we had to have the Louvre Accord about 2 years later to try and bring it back up. So the G7 can, and it has the firepower and it has the authority, I think, to if it wants a turn in the market, it can achieve that turn. Now, it may have to time it well. It may have to, however it words it, or the way it does it might be open to question. But I think if it really wants to stop the dollar from going up, I think it can.
Okay. And if China's not included, you have a caveat here, is that the whole thing could be torpedoed by China.
That's a difficult one. If the G7 wants China to, but again, the US and China don't see eye to eye on much. I think that's right. That's something of an understatement. It's not controversial. However, the stability of the global financial system, China has an interest in maintaining that. The US has an interest in maintaining that. They're codependent in many ways, and the most obvious one being, China's trade. Holdings of treasury. Well, there's trade, there's world trade, there's trade between the two countries, but China's holdings of treasuries, it may not be getting the news and the attention from people in the market, or people like myself, as much as it did perhaps 10 years ago, or pre-crisis. But China still holds probably over $1 trillion worth of treasuries. Its reserves are still around $3 trillion, most say 60% plus perhaps of that in US dollars or dollar assets. So they have a mutual interest in not wanting that whole system to unravel. So might we get China to sign on to something, or to give a nod or a wink to any G7 communique or stance on the dollar? I don't know. I don't know how that would work, but I do think it's not fanciful to think that China and the US could see eye to eye on that.
Okay.
Especially as China wants the dollar to stop rising and wants the yuan to stabilize.
Okay. So it's in the interest of almost everybody. And do you think that it actually gives the Fed cover to keep raising rates? Because if the dollar weakened, it would nominally support commodity prices and make inflation stickier. So they would, have cover to continue to tighten.
It's a tricky one because on the face of it, you would think that the strong dollar, the rising dollar is good for the Fed in its fight against inflation, which it is. But I would suggest that it's maybe not quite it's not quite as influential as you might think. Obviously, all these commodity prices and energy prices, oil, etc., is all priced in dollars. The US is a relatively closed economy compared to the big economies in Europe and in Asia. So the impact of the dollar on trade flows and import prices in terms of trade, etc., is not as strong as it is for other major economies. So the dollar rising is, the Fed is quite happy with that, and I think we've seen that because the Fed hasn't said anything really on the dollar. It's been made no effort, no public effort at least, to rein that in. Could the Fed swallow another 5-10% rise in the dollar? Yes, but equally on the other side, given that the dollar's impact is not as powerful on US inflation, could it swallow the dollar coming back down 5 or 10%? Probably yes as well.
Okay, so it could be a sacrificial lamb here. And
I would say it's more of a financial stability issue. I think as we just talked about, the dollar wrecking ball. I think if it starts to rock financial markets, I think it's more of a financial stability issue, perhaps for the rest of the world. That's when it becomes an issue for the Fed, as opposed to its direct impact on inflation, because its direct impact on inflation isn't particularly strong, or not as strong as we might think it is.
So why don't we move to the future, Jamie? And
as one of your guests just said before, it's impossible to predict.
Well, there's already talk about the November meeting of the Fed that they're not going to go 75, that they're going to go 50. We're going to have some inflation news or something like that to reinforce the fact that they could pull back a bit. And that's not a pivot, but you're throwing a bone to the market that we're hearing you a bit. We could be getting closer to the end, but it doesn't mean we're going to ease again. It just means the rate of increase is slowing. like inflation might be?
Well, that's that. I think everything, all these markets, the pricing of financial markets now hinges on that. As you say, a pivot does not necessarily mean a switch to easing, although there's still easing priced into next year. Just before we started speaking, I was looking at the 2023 SOFR curve, and we're looking at 25 basis points of easing is still priced into next year. Now, 25 bips is in the grand scheme probably neither here nor there. And it was only a couple of months ago that about 65 bips of easing was priced into next year. And also, I think we're looking at since the Fed last met 2 weeks ago, or was it last week, we've had about 40 basis points of hikes taken out of the short-term curve. So the terminal rate is now down to about, I think, what, 4.35 now is the terminal rate for March, June next year. About 2 weeks ago, it was up to 4.75, 4.80. So the market is already, as you say, starting to price in a slightly less aggressive Fed, and I think that's fair. I think, as you were discussing in your last show, some of the economic data is going to start to turn. We've got ISM data coming out soon. I think some of the hard data is going to start to soften. Maybe payrolls is going to start to soften too, and that's understandable. I mean, you don't have this degree and pace of rate hikes, financial conditions tightening without it having some sort of economic impact. And I think the landing strip for that soft landing is getting narrower and narrower. So some sort of Fed taking its foot off the pedal is to be expected. And again, just before we came on, I was looking at break-evens. You're talking about inflation and inflation expectations. There's been a dramatic fall off in break-even inflation rates. 5-year and 10-year US break-evens are now down to about 2.1%. So that's back towards basically Fed target. So if you take break-evens as a guide towards the markets, to where the market thinks inflation is going, you can say that the market thinks the Fed's going to be bang on, is going to do its job, and inflation in the next few years is going to come back down straight towards target. We had the UMISH expectations, 5-year expectations on Friday, again coming down to 2.7%. That's the lowest in about 18 months. So the market thinks the Fed is achieving its goal on inflation. Again, whether that's within the next year or 2 or 3 years, we're not quite sure. But inflation expectations are certainly coming down. Oil prices are down, to $80, $85 a barrel now.
Yeah,
we're much higher than that. And the year-on-year increase in oil is back down to about 15% from way. So the signs are inflation is starting to moderate.
That'll be the next story. So will we shift from worries about inflation to worries about growth?
Most certainly.
And that could be behind an interest rate abatement of the pressure. In fact, we're already starting to see it. Maybe this high that we had in the 10-year at 4% might be a marker for a while.
Well, if you think inflation's coming down, and it seems to be, or certainly inflation expectations are coming down. If you think inflation is going to come down, if you think temporarily, but certainly come down from the 8, 9, almost 10% levels, and you think the Fed tightening is having its desired impact, you think the economy is going to slow, possibly go into recession. I think recession sometime late next year is not an uncontroversial call. Put that all together, and you see the 10-year yield at 4%. I think a lot of investors might think, I'm going to lock in at 4%.
Yeah.
And again, that's not particularly uncontroversial, especially when you see, as you were also talking about earlier, some of these calls on the S&P. I think we're down past the 3,600 target that many people had. We're now looking at 3,400. Again, you can argue, are we due for a bounce? Probably yes. But
it looks like it.
It looks like it, and I think there was a great stat from the guys at Carson Group, Ryan Detrick. I don't know if you guys follow him on Twitter, but he was pointing out that the S&P 500. The start to the year has been, as we all know, one of the worst on record, and I think only since the Second World War have we had worse starts to the year for the S&P, and I think that was 1974 and 2008. Now, what's interesting about those years is that in Q4, after this horrendous start in Q1, 2, and 3, guess
Big
what?
recovery.
The S&P, not well, 7.9% in both years. Quite coincidentally, it was 7.9% in Q4. They bounced back, so we could be in for a bounce. However, having said that, if you think the financial environment, the market environment, and the economic environment are still pretty, I don't know what word to
Dicey?
use, grim, dicey, uncertain, and you're
Yeah.
seeing treasuries at the safest asset on the planet at 4%.
There's competition now.
Yeah, I think that
Right. There is an alternative.
equity risk premium is maybe in favor of bonds right now.
Yeah. Okay. What a great interview, Jamie. And so what I want you to think about is the biggest financial story, I think, since Nixon closed the gold window for our next discussion. Your views on the CBDC. And what do you think it's going to be? Why are you laughing?
Well, but it's not because when you're kind of in the weeds and you're being distracted by what's going on on the screens in front of you, it's hard sometimes to take a step back and have a look at those multi-generational trends.
Well, how far away is it? I hope 20 years, but it's not, Jamie, is it?
No, these things will creep up. But I think the biggest story right now, and as we've discussed, is the dollar and the tightening of financial conditions. And are we getting closer to a point where we get some sort of action, whether it be verbal or otherwise, from G7, I would say, or authorities on some sort of coordinated action?
Okay, so Jamie McGeever and Dale Pinkert calling for the cavalry. It's time for them to step in, right?
Well, if they don't step in, if they don't do anything, does the dollar just keep on rising and rising?
Yeah, bail out the world, Fed.
And if it does keep on rising, that is unsustainable, and something's got to give. I wouldn't say break, but something's got to give.
It sounds a lot less expensive to take the dollar down. Isn't it easier to debase your currency than to make it go back up when it's in trouble?
Well, the Fed. I mean, I don't think the Fed would get in selling dollars, or perhaps it would give a nod and a wink to other central banks to do that, like the Bank of Japan, for example, or maybe the Bank of England. And we've not even spoken about the ECB in this half an hour, but they're under huge pressure too, and the euro's going down, and they face a tough winter, energy prices, a falling currency, high inflation, 17% inflation in the Netherlands. 17.
Yeah. Aren't you in Florida, Jamie?
Yes, I am. Okay,
were you a Spirit?
Yes, fortunately, the house is still standing, as you can see. But yes, I'm in Orlando, East Orlando.
Okay, it got bad there for a while too.
It did get bad, and when I was outside, there is a lot of damage around. We were spared, but there is damage around, and it was. I think it's been pretty tough for. I mean, we had friends of ours who had to be evacuated, only 5 minutes down the road.
Yeah, it makes a trade that doesn't work look small.
Yeah, I think there are much bigger problems in the world than whether the dollar's going to 145 or 146 yen.
Well, grateful that you're okay, praying for the people of Florida. You don't know if you have faith till you need it. And thanks for a great interview and like-mindedness about what central banks may need to do. Appreciate it.
To watch. Thank you very much, Dale, and speak soon.
Follow Jamie at Reuters Jamie for a great resource for knowing what's going on, not just the Fed, but everything going on. One of the best columnists at Reuters, Jamie McGeever. We're fortunate to have you come and edify our community, Jamie. Thank you.
Very kind of you to say so. Thank you very much, Dale, and speak to you soon. All the best.
Okay. All right. Jamie McGeever, everybody. Thank you for your attention. You could join the team in 11 minutes on the Morning Edge. Don't just count your pips, count your blessings. and let's have the cavalry ride to the rescue. Thanks again, Jamie.
Thank you.
Adios,
Take care.
buddy.
Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.